everyone, welcome to the Alpha Hustle. This is the weekend review of Nifty and Bank Nifty, where we will talk about how market auctioned last week with potential scenarios that may likely to play out next week, along with some important references to watch out for. So let's quickly get started. All right, so let's start with the review of the Nifty followed by the Bank Nifty. We'll start with the monthly charts, followed by weekly, and eventually getting down to the daily and the market profile charts. So on the monthly charts for Nifty, we could see that the one-time framing to the upside is still intact. However, the higher prices have brought in the selling pressure. The higher prices have brought in the selling pressure that leaves a 1,000-point selling day. So as long as the lows of 2021 is intact, we could say that the longer term time frame is still interested to the upside. On weekly charts, the one-time framing to the downside continues for 2 subsequent weeks, with sellers approaching on every rise and marking the prices down. We have an important nuance of 14,500 where the buyers failed for 2 consecutive weeks to get a closing above 14,500. This zone has been taken out post budget rally. So this zone that acted as a resistance is likely to act as a support now. So we are currently right at the inflection point. So the next week will give us the hints whether we're kind of breaking down and heading lower, or if some responsive buyers could step in at this very important level and mark prices higher. We clearly have a structural change on the daily charts. Though we have this freak high that was formed on the 24th of Feb at the back of the drama that we had on NSE, I would still consider this as a freak high and not kind of include within the very short term charts. So this 15 to 30 level that marked the high of last Thursday would be the lower high. So the context in a very short term has changed from higher highs, higher lows to lower highs and lower lows. One of the other important nuances that we have on the daily charts are the gaps that were left by the sellers here between 15,050 and 14,950, and a gap that was left by emotional buyers post budget rally between 14,400 and 14,480. As Jim Dalton says, gaps are often caused by emotions, and all such emotional gaps are tend to be revisited in the future. Given the high rise in the volatility in VIX, we may potentially have these zones revisited for the strength of those respective players. So for example, this zone of 14,400 and 14,480 is backed by strong buyers, whereas this zone of 4950 to 15050 is backed by strong sellers. The action loss Friday was backed by strong hand sellers. As you can see, a big spurt in the volume, which basically is approximately 2 times the average volumes that we had over the last 20 odd days. So this suggests that the sellers that have come in that pushed the prices with a huge gap, potentially some strong hand sellers. However, it's important for these sellers to get a follow through to last week's low. Another important nuance to watch out for is how good is this down move that we had on Friday. We had a nice bearish candle, pretty much closing towards the low point of the day, with volumes spiking. However, the cumulative OI dropped. This suggests that the move on Friday was at the back of longs liquidating as opposed to a huge volume of shorts accumulating. So we had some nice longs being built up on the 24th and on the 25th of Feb, who have eventually liquidated on the 26th after a big gap down. The zone of 21 DMA and 50 DMA is acting as a strong support ever since the V-shaped recovery has started during the month of September and October last year. All the pullbacks towards this 21 DMA and 50 DMA zone has been used by the responsive buyers to step in and push the markets higher. Be it October, December, or January, the buyers who have stepped in around these levels push the markets towards the all-time highs. We are now approaching this key inflection point, an important zone towards the 50 DMA. It gets interesting to see how the buyers would respond to this price. Let's take a look at the volume profile charts. The zone of 15200 and 15250 is acting as a strong resistance. So all the rallies towards the zone are being sold into. While on the downside, the zone of 14400 and 14600 is likely to act as a strong support. Now the market is approaching this key demand zone or HVN. So it's important to understand whether the buyers are going to step in this time to mark the prices higher. If this HVN gets taken out, market is likely to probe lower and trade within this thinly traded zone of 14,000 and 14,500. As per the traditional technical analysis, market is now approaching the lower trend line of this rising channel. So this zone of 14,400 and 14,500 is going to be a very important reference. Now let's take a look at the market profile charts. Last week started off with the continuation of one time framing to the downside on the 22nd of Feb. However, the selling has been stalled on the 23rd of Feb with some responsive buyers stepping in to stop the one time framing to the downside. This led the short covering rally on the 24th and the 25th back into the prior supply zone of 15,200 and 15,250. However, there was no follow through to this price action, and with a big gap on the 26th of Feb, led the liquidation of all those longs that accumulated on the 24th and 25th. Though some responsive buyers appeared near the 14,500 and 14,550 zone, they weren't strong enough to push the prices higher. This led the market to close near the low point of the day. Now let's take a look at the important references and potential scenarios that may likely to play out next week. We have a B-shaped balance between 14,520 and 14,730. So the references to the upside is one, the rally high at 14,730. Any acceptance above the zone of 14,730 is likely to open up short covering move towards the probe of the gap that's left at 49.50 and 15.050, above which the market is likely to probe the HVN and the weak references at 15,150 and 15,200. References to the downside, open-end acceptance within the B-shaped balance is a confirmation of lower distribution that may have the odds for the probe of the low of the last week at 14,520. Any acceptance below 14,520 is likely to probe the gap at 14,400 and 14,480. Below 14,480, we have a triple distribution day on the 1st of Feb. So any acceptance below 14,480 is likely to consolidate between 14,000 and 14,500 zone. OI suggests that the call writers are quite aggressive while put writers are not. So the path of the least resistance is to the downside. Now let's move on to Bank Nifty. On the monthly charts, the one time framing to the upside continues, suggesting that the interest for the longer term time frame is still on the upside. Well, on the weekly charts, the one time framing to the upside was stopped last week with the sellers pitching in and marking prices lower. However, the market is still trading above the prior all-time high zone. On the daily charts, clearly there has been a change in the structure from higher highs and higher lows to lower highs and lower lows. So we had a lower high formed on the 25th, where the markets sold off above the 37,000 levels, leaving a selling tail for the day, followed by a gap down and the liquidation of the longs all the way below the 35,000 zone. So the context has clearly changed from buying the breaks to selling the rips. The continuation to the downside on Friday was at the back of strong sellers. This is a sort of a disconnect from what we have seen on Nifty. However, Bank Nifty is turning out to be a little weaker when compared to Nifty. Nifty is approaching its demand zone, whereas Bank Nifty broke down from its HVN. The zone of 21 DMA and 50 DMA has been acting as a support in Bank Nifty too. Though it's not as clean as it was in Nifty, where it was quite mechanical in nature, where the buyers were coming in right at the 21 DMA and 50 DMA. Whereas in Bank Nifty, we had few instances where the market broke below these levels. However, the buyers, irrespective of the exact levels, have pushed the markets higher. As we have seen earlier, this zone of 36,000 is a highly traded zone or HVN, the high volume node, and we have seen that the prices have broken down below this. So any continuation to the downside is likely to fill in the volume within the thinly traded zone of 33,000 and 35,000. Now let's take a look at the market profile charts. Last week started off with the continuation of one time framing to the downside on the 22nd of Feb, followed by the responsive buyers stepping in on the 23rd to stop the selling and stop the one time framing to the downside. We had a nice follow through with a short covering rally on the 24th and 25th, back towards the HVN and the distribution that we had at 36,820 and 37,400 zone. So this zone of 36,820, 37,400 was a zone where the longer time frame sellers have stepped in to mark the prices lower with starting the one time framing to the downside. So this rally towards this HVN and distribution zone has been used by the sellers to sell into, where the market closed towards the low point of the day. A big gap down on a subsequent day on the 26th of Feb led the liquidation of the longs that accumulated their positions on the 24th and 25th. Though there are some responsive buyers who have stepped in near 34,600 zone, they weren't strong enough. Market closes towards the low point of the day. Now let's take a look at some of the important references and potential scenarios that may likely to play out next week. We have a B-shaped balance between 34,650 and 35,350. So the references to be upside is a rally high at 35,350. Any acceptance above 35,350 is likely to open up short covering rally to probe towards the gap zone of 36,000. While the references to the downside, open and acceptance within the B shape is likely confirmation of lower distribution, and any acceptance below 36,650 is likely to probe the gap at 33,500 and 33,600 zone. Now let's take a look at how FIIs, pros, and retail clients are placed in terms of their positions. FIIs and the pros have been on the long side for the first half of the month, while they turned negative in the latter half, and the clients were on the exact opposite side. Though the FIIs are on the long side during the first half of the last week, they turned negative on the 25th and the 26th, where they have built some huge short positions. Same case with the pros, where some good substantial shorts have been built in the system on the 25th and 26th, while the clients have gone long. So in short, for the month of Jan and Feb, the FIIs and pros were on the short side, while the retail clients have been building the long positions. So it's important to understand how March gets a follow through, as Monday being the first trading day of the month, and any acceptance or any follow through to last week's price action is going to bring in more downside. With regards to the open interest, the call writers have been quite aggressive compared to the put writers. So 35,000, which acted as a support earlier last week, is now probably going to act as a resistance. So if this zone gets taken out, then there are odds for short covering move all the way towards 35,500 and 36,000 zones. Any acceptance below the Friday's low is likely to bring in more downside. That's all for today. Thank you very much for joining and listening. Have a nice trading week ahead.